Listen, we got the vaccine news that Bertha just delivered here. We've got this election thing you might have heard about coming up. We've got the fight over stimulus. In your mind, what might be the market mover more than anything else?
The election. That's going to be the market mover, and more specifically, when we have a resolution to the election, because it's not clear that that's going to occur near the November 3rd deadline. So what we need is to remove some of this uncertainty from the market. By that time, we will have a better indication of where the increase in cases for COVID is going. We'll have a better indication of where we are with the stimulus we need to power our economy. And we'll have a better indication of whether we can look past the election and all these uncertainties and start looking at 2021 earnings, where we'll be looking for the sectors and the companies that are poised for growth in that year.
And who do you think those sectors and, Greg, those companies are that are poised to growth next year?
So I think that this is playing out a lot like we saw the last time we went through something like this. And so we saw in 2010 to 2012 that tech and growth actually underperformed as other cyclical and hard sectors in the economy started to rebound off of a bottom. And so just as we saw then, the S&P 500 minus tech is expected to grow around 35% next year, while the average growth in tech stock is expected to grow around 15%. So in that environment, when you think about the high multiples that some of these names have, having benefited from our current environment, you'll want to start to parse what can continue that level of growth next year and warrant that high multiple versus other things that will be growing from basically a negative or no profit and experiencing triple-digit earnings growth. And for that latter category, I'm looking at financials, which are expected to grow about 100% next year. In many cases, trading at a significant discount price to tangible book, as well as offering a hefty dividend. Some consumer discretionaries are in the same boat, where they'll have a hefty dividend, they'll have triple-digit earnings growth, and are trading at a very discounted multiple based on their own history.
Because, you know, we're supposed to buy low and sell high, or maybe buy high and sell higher, Greg. And you talk about the fast-growing tech companies. We all know those. You got energy and financials that are down on the year, both looking pretty grim. Sounds like you're fairly bullish on some of the financials. Can you be more specific? Are there any banks or financial names that you think offer you and your clients some good value?
Yeah, and to some extent it depends on what your time frame is, but if you're looking for exposure now, I would look at the more diversified, larger names, again, trading at a significant discount on price to tangible book, but they also have the diversity to continue to deliver earnings growth even in this environment. So when you look at the larger banks like JP Morgan and Citi that have trading operations, that have investment banking, they've been able to counter to some degree the loan losses we have seen and probably will continue to see for the next few quarters. So I'd look large for now. And once we have reached what we think is trough earnings, once we think the provisioning is done, then there's value elsewhere as well, based on the multiple versus history, based on the trajectory that we'll see from these banks.
Shepard Smith here. Thanks for watching CNBC on YouTube.